Hello investors, today's topic is ROE versus ROCE. ROE is return on equity and ROCE is return on capital employed. I'm sure you know about it. But I think probably the thing which you don't know about is which ratio should we look at seriously while investing in a stock. So let's decode it. So ROE is nothing but the net profit to the shareholders' equity. This can also be quickly derived by just dividing earnings per share divided by book value of a share. Because earnings per share is nothing but the PAT of the total company divided by shares outstanding, and book value is nothing but the shareholders' equity divided by the number of shares outstanding. So the easier way of understanding or calculating ROE is earnings per share divided by book value. You will readily get this ROE percentage from various apps as well, so nothing to worry about it. But this only tells a broad ratio wherein what the company is generating as returns with respect to its shareholders' equity. What the shareholders has invested in the company and what returns the company is giving with respect to that shareholders' equity. But then ROCE gives a more realistic approach of returns generated by the company and the overall efficiency of the company, because it accounts for the debt taken by the company as well. In the sense, ROE doesn't account for the probable debt the company is having, and if the company has taken a bigger debt, then the ROE figure will be a bigger value and you will think that the company is so efficient. But then that returns are probably driven by the huge debt the company has taken. But then ROCE, return on capital employed, the figure is derived by the equation EBIT, earnings before interest and tax, divided by the total capital, which is nothing but equity plus debt. So it accounts for both equity and debt. So if the debt is high, then the ROCE figure will be lesser. But then if the ROCE figure is high, which means that the company is effectively utilizing its debt and generating good returns for the company, so which shows the effective utilization of both equity and debt by the company. So the effect of leverage and how effectively the company is utilizing the leverage is understood from the ratio of ROCE. So probably if a company is having a high ROE and a low ROCE, the company is not good if you ask me. But if the company is having a moderate ROE, say 10 to 12%, and if the ROCE is as high as 18 to 20%, then it is a good company and it is worth investing in that company with a long-term view. So as a value investor and a long-term patient investor, you should always prefer a company with a moderate 10 to 12% ROE and a high ROCE of 18 to 20%. This ensures that company is utilizing debt properly, it is not overburdened with the debt, and the returns is generated through a balanced amount of debt and equity, so that the company is profitable and will give you consistent earnings and stock price appreciation as well. See you in next video. Till then, happy investing.